and thank you for joining us today. I'm Adi. I'm leading the crypto desk at eToro. I'm in charge of the crypto hedging and pricing strategy. Anna, would you like to present yourself?
Sure. Hi, everyone. My name is Anna Stone. Good morning. Thanks for joining us today. At eToro, I work as a director of growth, focused specifically on crypto, Web3, NFTs, and have a background in decentralized finance and working on-chain and Ethereum, and excited to be talking to you guys today about some big happenings that's happened in the crypto market over the past few months. So welcome to the webinar.
Exactly. So today we're going to discuss, I guess, one of the largest events in the crypto history. We are going to talk about the Luna and USD crash causing more than $50 billion in total capital destructions. So we are going to go through the chain of events, the implications, and the outcomes of these events in hope that we won't have to repeat this again. Anna, maybe let's start with explaining what is a stable coin and what are the different types of stable coins.
Sure, great. So I think for those of you who have attended this webinar, for me, if you remember one thing from this webinar, it's to remember that not every stable coin is created equal, right? So first and foremost, let's go about defining what a stable coin is. So at its most basic, a stable coin is a crypto token or a crypto equivalent that's linked to an underlying asset, right? So the most common stable coins that exist out there are those that are based off of the US dollar or based off of the euro, right? Where 1 unit of the stable coin is equal to $1 US or 1 euro. So that's the framework for what a stable coin is in general. Now, as I said, not all stable coins are created equal, right? So there are multiple different types of stable coins. And in the crypto ecosystem, they break down broadly into two big categories. On-chain crypto assets, so stable coins that are collateralized or backed with on-chain crypto assets, or those that are collateralized with off-chain assets, okay? So non-crypto native assets. And we'll actually start with the left-hand side of this chart, which is fiat collateralized stablecoins and commodity-backed stablecoins. And so these are stablecoins that are backed with off-chain assets. They're backed with non-crypto native assets. And we'll go through two examples that you guys are probably familiar with, okay? So one of the most popular fiat collateralized stablecoins is USDC, okay? USDC is a collaboration between Coinbase and the company Circle. And what they do is they issue the USDC stablecoin. And the USDC stablecoin is considered to be the gold standard because it's fully transparent and basically audited that for every USDC issued, there is $1 in the USDC reserve, okay? So if you want 10 million USDC, you need to put 10 million US dollars into the Circle reserve, the USDC reserve, okay? And so this is audited and known, and so there's meant to create confidence that when you have 1 USDC, it's equal to $1, okay? Now we'll switch to the next, which is a commodity-backed stablecoin. And probably the most famous commodity-backed stablecoin is Tether, okay, and has been around the longest. And Tether is also 1 USDT equal to $1, right? The difference is that the collateral that backs Tether is actually backed by a mix of different commodities, of gold, of oil, etc., right? So it's not crypto native collateral. It's based off of other types of commodities or other types of utilities, including currencies, right? But it's still designed to equal $1, right? So you have to understand that the reserve of that, there's underlying price implications, right? The price of oil changes, the price of gold changes, but the important thing is to understand that it's backed with non-crypto native assets, right? The commodity-backed stablecoins, of which Tether is the biggest example. On the right, so I'm going to stop there. Any questions, Adi, before I continue with the crypto-backed stablecoins?
No, but I think and there is also a mix, right? Some of the coins can be both backed by fiat and with commodities.
Exactly, and so Tether has both currency plus commodities in their reserve, right?
Yeah.
Then when we move on to the right-hand side of the chart, we've got the inherently crypto-native stablecoins, right? And these are stablecoins that are also meant to be pegged to one particular value amount. However, the reserve that backs them are crypto-native assets, okay? And there are two different types of crypto-native stablecoins. The first is crypto-backed stablecoins. And so these are crypto-native tokens that work really quite similarly to fiat or commodity-backed stable tokens, in which the tokens, the crypto stablecoin has other assets that are actually fortifying its reserve, and typically a mix of other assets. So the most popular example of a native crypto-backed stablecoin is DAI. And DAI is an example of a stablecoin where one DAI equals $1, and it has a mix of crypto-native, Ethereum blockchain native tokens in its reserve. However, it's over-collateralized, right? So you need to put in 1.5 Ethereum for every one DAI that's issued out, right? So because there's real collateral, it's in a smart contract, it's locked on chain, and DAI itself is over collateralized. That's designed to accommodate for these different volatility in the price of Ethereum or in the price of the other assets that are in the reserve. And then the fourth category, and so I'll just say that decentralized stable coins that are backed by other crypto assets, DAI actually has been pretty resilient and pretty market tested, survived a number of different crashes to date, which makes, I would say, experts more comfortable with that model, if you will. Yep. And the fourth category, which is where Luna and Terra fall into in this episode, is a category referred to algorithmic stablecoins. And algorithmic stablecoins it's actually a non-collateralized model, but rather a mathematical model. And this is based off of that the demand for basically creating two different tokens. One is pegged to a particular value, let's say $1, which is what the USD Terra was pegged to. That's backed by a second token, which is volatile and changes to the market. And that's the dynamic of the Luna ecosystem, where the value of the stable coin is influenced or backed up by the value of the volatile asset. And there's a constant rebalancing of those two elements that's designed to create stability. However, algorithmic stablecoins are not new. There've been a range of different algorithmic stablecoin experiments, and they are known for having real challenges in terms of how the mathematical models function when put under real market stress. And that's part of the phenomena that we see with Terra. Yep.
But we are still, we are witnessing an increase in general in the adoption of stablecoin, both in all the different types that you just mentioned. So what are the use cases of these tokens? Where do we see the investors are using it?
So I think it's a critical point to discuss, which is that we often think of crypto gets a bad rep for having the most volatile assets, and actually having the assets that are known for having the highest amount of price variation. But the reality is that, as you pointed out, Adi, stablecoin supply has grown alongside the crypto industry, and that's because turns out that having a non-volatile asset is super, super useful and necessary for having a mature asset class, right? So I think first and foremost, one of the first use case that stable coins were really used for is for a trading use case, right? Yeah. So crypto, unlike the stock market, is 24/7. The markets never close, right? So if, for example, you are a trader and you want to get some sleep and you don't know what's going to happen overnight, many traders, and this was one of the first use cases for USDT, would flip their Bitcoin or flip their crypto assets into stable coins overnight, right? Because it provided you with the certainty that you could sleep at least for 6 hours until you wake up the next day, right? So I think that's the first use case that we've seen. Yeah. But certainly, that's not the only use case, and that's probably not the most critical use case, which is that one thing that we've noticed is that, look at what's happened over even the past year in this chart right here. What this shows is that, let's say the crypto industry is around $1 trillion to date. Around a fifth of that is going into stable coins. And it's because stable coins aren't just being used for trading. They're also being used they're fundamental to DeFi. Okay. Right. And decentralized finance, which is that if you're going to be and yield protocols, and this idea that stable coins are fundamental to offering people, let's say, essentially a predictable return or a more stable return on the tokens that they're loaning out. And they're also fundamental to the payment systems that DeFi is supposed to be known for, right? So there are many examples of stable coins beginning to be used and implemented to support peer-to-peer payment systems, as well as being foundational building blocks for building this decentralized finance ecosystem where people need to have, actual trust and more reliability in order to use these instruments.
Yeah, and some of these points, I guess, will appear when we now walk through the chain of events of what happened in the massive collapse of the Luna and UST, right?
Yeah. So
yeah.
I think.
Go ahead.
I think first and foremost, Adi, let's set the stage for people a little bit. First and foremost, as we mentioned, UST and Luna is not the first algorithmic stablecoin experiment. Okay, there have actually been algorithmic stablecoin experiments that have been around since, I think the earliest one started in 2014, that have attempted to solve this problem of how do you create an inherently stable asset without having to lock up millions and millions or hundreds of millions or not, if not billions of collateral, right? So this experiment has been tried a few times before, right? And the theory here is that any algorithmic stablecoin is intended to maintain stability through basically a one-to-one mint of its stablecoin and the token that's meant to, let's say, collateralize its system, right? So an algorithmic stablecoin will actually reduce the number of stable tokens in circulation when the market price of the volatile token falls below the price of the fiat currency that it's meant to back. Okay, so let's explain that for a minute. There's meant to be a relationship here between so let me back up. Luna and Terra are parts of the same ecosystem. Okay, they are members of the same ecosystem. UST is meant to be the stable coin. Okay, UST is meant to equal $1. And what actually backs or supports the peg of the UST stablecoin is the price and number of Luna that are in circulation. Okay, so there's a correlation here between the stablecoin, USDT, and the price,
USD.
which is always meant to equal $1, and the price of Luna, which is a volatile token and exists outside of the system. And what is meant to occur is that there is a balancing between these two, right? So that's what this chart actually shows, is that that there's a constant, the way, if we actually start with the right-hand side, they call this model a seigniorage model, right? So as there is UST that exists and is created, excuse me, I said it the wrong way. As UST exits the ecosystem, as dollars are sold, more Luna exists, okay?
Right, because there is a redemption of 1 USD to 1 equal Luna token. So there is always
exactly
the connection
right.
between, there is also always the connection between the UST token and the Luna token.
That's exactly right. And so what this means is that this constant rebalancing is what is algorithmic behind it, right? That's the math behind it, is this idea that as long as you can create an algorithmic mathematical correlation between the number of Luna in circulation and the number of USDT of Terra in circulation, the peg will hold. USDT will always be equal to $1. Excuse me. Will always be equal to, UST will always be equal to $1, irregardless of the number of Luna in circulation and the price of Luna in circulation, right? And so this is, but in order for that to work, you need for there to be confidence in both of those tokens, okay? You need there to be market confidence that that algorithm is going to continue to hold and maintain irregardless of people buying and selling Luna.
So what happened that led to this major crash? Like, what were the chain of events that happened?
So I think the first thing that people need to understand is that at its height, this chart actually doesn't even show the height of the Luna ecosystem. But if this chart started in February or March, you would see, actually it does, because it shows the 30 billion for Luna and the 20 billion for Terra. So excuse me, if we look at May, we see that Luna is actually started off as a $50 billion ecosystem. Now, how do we get that? So Luna is a Korean company, just so you guys understand. It was formed by a Korean entrepreneur. And one of the ways that they gained really rapid adoption was actually through marketing this stable coin as being stable, and therefore people being able to earn, it was a 20% return, 20% return on holding Terra in what they have an app called Anchorage, right? So this was a dApp that was designed to actually enable people, retail investors, based the Anchor protocol that enabled people to really stake their Terra and earn a 20% return off of it in Luna, right? So that's what they actually, that's how consumers or retail users used it. Keep in mind, though, that Terra grew because it was supported by some of the biggest VCs and investors in the ecosystem, right? So it wasn't just retail people that actually were holding Terra and were unaware of what's going on. Terra actually was supported by a number of the, leading crypto analysts and funds that gave it a fair amount of legitimacy, if you will. So what we see is that beginning in May, we have a $50 billion ecosystem where that is, basically inherent to itself. It's the Luna Terra ecosystem. And there are essentially $20 billion of Terra in the market that are backed by $30 billion of Luna. And beginning in May, as we look through the first week of May, you'll see that this starts to destabilize, right? The price of Luna starts to shake. And this was driven by a number, I think it's attributed to like two or three different key trades that really, let's say, shook the price of Luna. And you begin to see that starting around May 8th, the price of Luna begins to nosedive in a way that then rattles the entire ecosystem. So what happens here is that as Luna begins to act, the price of each Luna in the market begins to be sold off. That's what we see here. Lunas are being sold off at mass. And this creates pressure on Terra and its ability to maintain its price peg of 1 UST equals to $1. So what people begin to see on the exchanges, okay, is now 1 UST is not equal to $1, it's equal to 99 cents. And actually, a few hours later, it's selling for 0.98 cents and then 0.97 cents. This is what you see happening on May 9th, May 10th, May 11th, right? Is the peg of Terra begins to slide. And as that happens, where and what's happening here is that the price of Luna is sliding, plus the stable asset that's supposed to work because it's in the math and it's in the algorithm, confidence begins to fall apart, full stop, right? And there we enter into, you know, what's considered a run on the bank, and or what they call it in this case is the death spiral, right?
Yeah.
Where there was a massive sell-off between all investors, institutional investors, retail investors alike, as there's a race to the bottom as people begin to understand that 1 UST is no longer going to be worth $1. And that if you want to get your capital out of this ecosystem, it's a matter of time of being the first to sell before the person behind you. Because if you're going to get 98 cents for your UST, the person behind you is going to get 70 cents, 50 cents, 10 cents, all the way down to zero. And that's what this chart reflects, is the two tokens actually collapsing rapidly within the course of a week as investor confidence and market confidence fails.
Yeah, so basically, once the confidence was lost, everyone just wanted to sell as quickly as they can. I guess like the surprising thing was how quickly it happened. Like in just 3 days, we witnessed a total collapse of both the Luna and UST. There were attempts to defend it. Like there were market makers who tried to bring back the UST value to $1. And the founder of the Terra blockchain, Duke Wan, tried to reinject confidence in the market, but they just failed to handle, I guess, the downward pressure. We also recently witnessed,
I was just going to say, and also just for the audience to be aware, it's also, I think part of the reason why they failed to restore confidence is because this vulnerability in the model was a known vulnerability. This wasn't something that it was a result, it was an unknown. No, as I mentioned, algorithmic stablecoins and their experiments have been around since 2014. They've all really suffered from the same vulnerabilities that we see in the same phenomenon. So I think for many people, once they saw the ball start rolling, they understood where it was heading down the hill. And therefore, it really even, to your point about the attempts to prop up the ecosystem, too little, too late.
Yeah. Yeah, and really everyone, like there are many voices in the market that says that it's super risky model.
Yes.
But the yield that they gave was just too attractive, I guess, for other investors to look over this. You spoke about the snowball starting to roll, and we have recently, it feels like that the Luna event also started a lot of other events to occur. We had the Celsius events where they seized any withdrawals from the platform. The crypto hedge fund 3AC goes bankrupt. Is it connected to the Luna? Is it like this event started other events to occur?
I mean, I think this is there's no one right answer here, but I'll tell you my own opinion, which is that crypto right now and the market, and we have all investors, all eToro attendees are people who are interested in the markets, are going through a contraction that's due to a range of different macroeconomic forces. Okay, this is my own opinion, which is that what we're seeing right now, it's driven by inflation, it's driven by interest rates, and it's actually quite a predictable retreat from high risk, high liquid, high return assets, of which tech stocks and certainly crypto is one of those asset classes. So what we see is an overall contraction in the market, and we know from past events that when the market contracts, weak players fall out, right? This isn't a feature, it's a feature, not a bug, right? That when the market contracts, inherently weaker players are those that are the first to go, okay? And so in many ways, Luna and waiting for its collapse was an open secret. There were many people in the industry that were waiting for, not necessarily wishing in a macabre way, but, had been anticipating something like this happening, right? So I think it's unsurprising that an event like this, which would happen correlated to the same time when the entire crypto market began to contract. I do think that there was some correlation, certainly revolving consumer confidence, right? So Luna kind of kicked off this spiral of fear around people being unable to get their money out, and maybe these, the promises, and people being people, and this is what we see happening with Celsius and 3AC as a fund, but it's a similar phenomenon of businesses that essentially had overextended themselves, overpromised. It's classic insufficient risk management. And as a result, unfortunately, their users are those who are bearing the brunt of it.
So regulation in general is coming to protect the users and the retail users especially that just suffered from these cases. Do we see now any change in the regulation as a result of the recent event?
So I think that, certainly regulators are looking at what happened with Luna carefully. And I know that that's happening not just in the US, but certainly like in Korea, which is the jurisdiction that Luna operated in. I know that Do Kwon is facing a range of different charges for tax evasion, and I think that's just the beginning. Just to put it into context, Bernie Madoff, who went to jail for the rest of his life, he defrauded investors out of $50 billion. So it's not, $50 billion is a big number. It happens also Exactly. So let's just say that regulators are looking at this case very, very, very carefully, right? I think in general, stablecoins have always been an area that regulators have looked at carefully, and it's with really good reason, right? It's because they are meant to be the confidence drivers of this entire asset class and of this entire industry. That's the first thing. And it's critical for creating trust across the more, let's say, volatile elements of the crypto market, because you need to have faith that the crypto equivalents that are meant to equal $1 or a euro are actually equal to $1 or a euro. The second thing is because the implications of what it has for consumers, right? And I think this is really critical. For me, this is another really critical lesson learned from the Luna case, is that in the Luna case, in their marketing materials, there was, let's say, a fair amount of consumer promises, right? Saying that UST is a stable coin. It's always going to be worth $1. Well, it wasn't necessarily clear. There wasn't a big asterisk there that was, it's worth $1 as long as the math continues to work and the market is confident in Luna, right?
Yeah.
And I think You know, I just see one question from the audience around what are the key factors in such a crash? How could you see it before it happens again? There's a phrase in crypto called DYOR, do your own research, right? And I think this is the biggest, the biggest takeaway here is that when you're dealing with these really bleeding edge nascent ecosystems, you really have to understand and read the fine print, because because they're outside of the scope of regulation. They're outside of the scope of regulation.
For
and
now.
As a result, for now. But you see, in my own opinion, Luna is a great example of why companies need regulatory guidance, because these are examples that do inherently, you know, this is a terrible thing that happened for the space, and it shouldn't happen again, and it hurts the industry, and it hurts the ecosystem.
Many people lost a lot of money.
Yeah, no, there are horrible human stories of loss that have come out of this example, and it doesn't push the industry forward. It doesn't create the confidence, or it's actually not I don't think it's really a reflection of the maturity of the industry. I think this is really like Luna is maybe like the last dying gasp of the DeFi degenerates, if you will. Let's see if that's remains to be true.
And I completely agree, and I think that in general the crypto community will come stronger from this. There are a lot of lessons learned, as you just mentioned some of this, and in general I think that for each one that is going to invest in anything, it is important to understand the risk in each investment and consider what can happen in extreme market conditions. And basically to invest based on your own risk appetite.
Totally. And I think for myself, Luna is a great example of, let's say, really owning that truth of you can't invest more than you're ready to lose, right? And I think that this is really true, you know, the higher risk, higher return you go, of which, you know, Luna's really out there in terms of like the higher risk types of assets and higher risk types of ecosystems. But there's a reason why people say that, and it's because of happenstances like this.
Yeah. I totally agree. So, like, you know, any summary of like last lesson learned, inputs to our audience on their next crypto journey, and it's not an investment advice, of course.
Definitely not investment advice. I'll share some human advice. I'll share some human advice, not investment advice, which is that it's, you know, the markets, it's hard, even for people who have lived through multiple crashes and work in the industry, it is hard to keep your zen, right? Because it's one of these elements where you feel like you're always waiting for the next shoe to drop, right? It's Luna, it's 3AC, who's next, etc. right? So it's really easy to find yourself falling into the cycle of anxiety. The only human advice that I have for the audience is to remember that, like, this won't kill us and life is long. And because life is long, markets are cyclical and we're playing a long game. And so it's not investment advice, it's human advice that you should stay confident in your own investing strategy that you've decided is right for you, because you can't time the market. You can't really play the market. You've got to continue to follow the right path for you in your own life. And that's something that I'm telling myself all the time. One question from the audience that I'll just answer before we log off is, how do you see the evolution of stablecoins in 10 years? Thank you. My hope is that within 10 years, there's a very clear regulatory framework for stablecoins. This is my actual hope. And both for, certainly for centralized stablecoins or those off-chain stablecoins, I think are going to become a really critical building block in terms of a mature crypto ecosystem. And I also am looking forward to seeing a lot of innovation around decentralized stablecoins. So not algorithmic stablecoins, but actually inherently crypto collateralized stablecoins. I think there's a lot of really interesting innovation in that space where people are looking to, create stablecoins that are backed with natural resources or tokenized versions of natural resources such as timber, et cetera, and really align preservation with the stablecoin incentives. And so there's a lot of really interesting innovation happening in that space. And I think that clear regulatory guidance and frameworks will be critical to it, stablecoin industry really reaching more maturation.
Yep, I agree. And I hope that the regulation will come in hands and will help us and not, give us too much of hard guidelines that we can't, that will hurt the crypto ecosystem. So Anna, I want to thank you very much for today's session. And I want to thank all of our audience who joined us today and the Invest With Her program for having us today. And we hope to see all of you in the upcoming events of Invest With Her.
It's been a pleasure. Thank you for having me. Thanks for coming today, guys.
Bye-bye.